When you start investing, one of the first challenges that you might encounter would be how to monitor your stock. On top of that, with information overload being the norm in our current digital age, is there a way to separate out the noise from the really important information that you need when coming to make investment decision? Well, with so much negativity now in the stock market, here are my 5 practical ways you can differentiate signal from noise in the market. Number 1, don't make investment decisions based on macro news. Right now, just by reading and listening to the global news can be very scary. Market is still in free fall, the US-China tension is not subsiding, and the cryptocurrency industry is a mess. However, if we look through history, in many examples, the macro environment has very little effect on how the stock market will react in the future. Many times, the stock markets actually perform quite opposite to what the macro environment is experiencing. For example, during the Cold War, one of the key tension points is the Cuban Missile Crisis, which happened in 1962 October. Interestingly, the market has already been declining at the beginning of 1962 as tensions are rising. And at the point of maximum pessimism, where the world seems to be on the brink of nuclear war in October 1962, that was actually the lowest point that the stock market reached. And then the stock market quickly rebounded and reached a record high at the end of 1962. So even if someone has invested at the peak in 1962, the portfolio would have recovered by the end of 1963, just 2 years later. And if we stretch it out even more, the S&P 500 index peaked in 1962 at around 70 points. Today, even after the crash, the S&P 500 index is trading about 4,000 points, more than 55 times higher. Let's look at another example. Back in 1987, the stock market has one of its worst crashes, commonly known as Black Monday, where the stock market crashed more than 23% in a single day. Again, after the market collapse, many investors are lost on how to react. It has actually become one of the lowest points during that crisis. And more importantly, after that event, the market recovered within 2 years. So by 1989, the stock market was back on making new highs again. And we can also see that happening in our home market. Back in 1997, during the Asian financial crisis, we can see that it took the Straits Times Index about 3 years to recover. And more importantly, even during the crisis, you will still be receiving dividends from all these companies. But what is interesting is when you observe the market rebound in 1998, the economy of Singapore was actually still struggling over the next few years. So although it is an assumption that investors feel that the stock market would be linked to the economy, the truth is that the relationship between the economy and the stock market are not really linear. In the long term, of course, the stock market might follow the economic growth. However, in the short term, the stock market are merely a collection of the feeling of investors. So when investors are feeling happy, the stock market will go up, and when investors are feeling rather pessimistic, the stock market will decline. So we should not really invest based on what we hear on the news. And before we continue, I would also like to thank our sponsor for this video, Seeking Alpha. Seeking Alpha is the largest investment community in the world, and it provides investors with a wealth of information through its database, news, earning transcript, and also crowdsourced analysis. Both personal and professional investors really find great investing ideas through Seeking Alpha. Personally, I also find it extremely useful to keep up to date with companies that I'm interested in. Right now, you can sign up for Seeking Alpha Premium Membership at more than 50% discount if you use our link in the show notes below. Now, let's get back to the video. Another strategy that you can use is by using the VIX Index. One of the ways for us to distance ourselves from being influenced by the market is by using the VIX Index. The VIX Index is a measure of how volatile the market has been lately. So when the market is feeling confused and jittery, you'll be able to observe through a much higher VIX Index. Now, if we look at the graph, by comparing the VIX Index to the S&P 500 Index, you'll be able to notice very often the best time to invest in the market is during times of great volatility. Thus, the general idea that we should wait for the market when it's showing uncertainty is actually pretty much flawed. When the market is most confused, sometimes it is the best time to invest. And that is especially true if we believe in these two things. Number one, that the market tend to go up over the long period. And number two, that we believe in fundamental-based investing, meaning that the stock price of a company should follow its fundamental over time. So if we believe in these two key pointers, there's really not much to fear in times of great volatility. In fact, we'll be able to use the VIX Index as a guiding point. For example, we'll be able to see that the index typically trades at a range of around 10 to 30 points. So even though the market has been quite optimistic this year, we can see that the VIX Index is still within this range, indicating to us that investor might not really be in a panic mode yet. So basically, the VIX Index is a good indicator on when it is a good time to start investing for us. So instead of worrying too much on the macro news, we can try to understand the current sentimental value of the market by using the VIX Index. Number 3, we can use technology to track our stock. The third tip is to use technology to track our stock. You might be asking, if we are not following the news, then how can we follow the stocks that we are watching or those that we have really bought in our portfolio? Well, we can use some automation tools for that. For example, if you are investing in mainly the US market, I like to use Seeking Alpha to track our portfolio. There is a website and also a mobile app for you to enter in your stock portfolio, and then the platform will just alert you on articles and news related to those stocks alone. And for other stocks outside of the US, I tend to use Google Alert. It is a free service by Google to alert us on any keywords that we want to track. So instead of Googling every stock that you own to find updates on them, we can just enter in the company name or the ticker into Google Alert, and Google will send you an email notification every single time there is news article or video about your stock. You can even set your notification to either a daily or weekly instance. In this way, you don't have to be bombarded with email from Google every single day. Next, number 4 is a good practice to do a yearly review on your portfolio. For example, monitoring your stock can be very time consuming, but unless there's any major changes in the company, I typically only review them on a yearly basis. This is because you'll soon realize that if you choose the right kind of stock to invest in, you will not really need to monitor them too closely. And some of the stocks that give me the most comfort and save me a lot of time on monitoring are stocks with high quality businesses and also stock with very simple business model. Say for example, in Singapore, a company like United Overseas Insurance has a very simple business model of selling general insurance. The business is also recurring in nature and tends to grow slowly. It almost doesn't matter who is managing the business, and in that sense, there's really nothing much to monitor. So the only document that I tend to read is the annual report every single year. And even from that document, I tend to focus on just a few sections that is important to investors like us. For example, at the minimum, I think we should read documents like the chairman's statement and management discussion, and of course also its financial statement. In particular, the notes on the financial statement. That will help us understand a little bit more about the business. And as you build up your portfolio, you'll realize that if you are investing in lower quality stocks, you would have to spend more time in monitoring them as their development might change rather rapidly. But if you're investing in high quality and simple businesses, then it will take us very little time to worry about them and also monitor them. And for my own portfolio, saving time in managing them is just as important as generating a good return on them. After all, we are all trying to create a passive income machine. And if we're spending so much time on it, it becomes just a second job for us. And the last tip I want to talk about is number 5, record down your thoughts. This is a good practice to start recording down our thoughts and research, as we can easily refer back to them when needed. For example, we can write down simple terms on why we like such a stock and why we're investing in them. So when we are reviewing them in the future, we will be able to refer back to our thoughts in the past and why we end up investing in them in the first place. This will also allow us to see if our original thesis for the company is still playing out over time. And if their business has already diverged from our original thesis, then we should consider if we want to sell them off or review our original thesis. For this part, we can use either a physical notebook or a digital notebook. Personally, I tend to use Microsoft OneNote for my note-taking and research, as it allows me to search through my past note quite easily. Of course, if you have other tips or advice, do comment down below to let all of us know. If you have gotten value from this video, I hope you give us a like and also share it with a friend who might benefit from it as well. And of course, please check out our sponsor Seeking Alpha on how they might be able to help in your investing journey. You can always support our channel by supporting them. So remember to click on the link below and enjoy more than a 50% discount on their premium membership. Anyway, as always, my name is Stanley. Till we meet again, invest safely.